When you enter the world of Forex trading, one of the first concepts you'll encounter is the spread. Understanding what a spread is and how it impacts your trading can significantly influence your profitability. In this article, we'll explore the intricacies of spreads, how they are measured, and the differences between fixed and variable spreads. Let's dive in. In Forex trading, brokers quote two distinct prices for a currency pair: the bid price and the ask price. The bid price is the price at which you can sell the base currency. The ask price is the price at which you can buy the base currency. The difference between these two prices is known as the spread. It's often referred to as the bid-ask spread. The spread is how brokers, especially those that advertise zero commissions, generate income. Instead of charging a separate fee for executing trades, the cost is embedded in the buy and sell prices of the currency pairs. From a business perspective, this model makes sense. Brokers provide a service and need to earn revenue somehow. They profit by selling the currency to you at a higher price than they paid to acquire it, and vice versa when you sell back to them. This difference is what constitutes the spread. Think of it like selling your old smartphone to a store. If the store plans to sell your iPhone for $1,000, they can only buy it from you for a maximum of $999 to ensure they make a profit. That $1 difference, that's the spread. When brokers claim to have zero commissions, it can be misleading. While there may not be a separate fee, you're still paying a commission through the spread. This is an essential point to keep in mind as you navigate your trading journey. The spread is typically measured in pips, the smallest unit of price movement for a currency pair. For most pairs, 1 pip equals 0.01. For example, if the EUR/USD has a spread of 2 pips, it might be quoted as 1.151, 1.153. In contrast, currency pairs involving the Japanese yen are quoted to only 2 decimal places. For instance, USD/JPY might be quoted as 110.04, indicating a spread of 4 pips. The type of spread you encounter on your trading platform largely depends on the broker and their business model. There are 2 primary types of spreads: fixed spreads and variable spreads, also known as floating spreads. Fixed spreads remain constant regardless of market conditions. Whether the market is experiencing high volatility or is calm, the spread stays the same. Brokers that operate as market makers typically offer fixed spreads. They manage large positions from liquidity providers and sell them in smaller sizes to traders, acting as the counterparty to their clients' trades. Advantages of fixed spreads include predictability, as they do not change, allowing traders to easily calculate transaction costs in advance, and lower capital requirements, making it easier for traders with smaller accounts to enter the market. Disadvantages include requotes, which occur when market prices change rapidly, and slippage, where the executed price differs from the intended entry price in fast-moving markets. Variable spreads fluctuate based on market conditions. Non-dealing desk brokers typically offer variable spreads, sourcing their prices from multiple liquidity providers. This means they have no control over the spreads, which can widen or tighten depending on supply, demand, and overall market volatility. Advantages of variable spreads include no requotes, as they adjust in real time to market conditions, and transparent pricing, benefiting traders with competitive pricing. Disadvantages include widened spreads during times of high volatility, impacting profitability, and being not ideal for scalpers, as widened spreads can eat into potential gains. Choosing between fixed and variable spreads depends on your trading style and needs. Fixed spreads are best for traders with smaller accounts or those who trade less frequently, offering predictability and lower initial capital requirements. Variable spreads are more suitable for experienced traders with larger accounts who trade during peak market hours, providing faster execution and better pricing due to competition among liquidity providers. Now that you know what a spread is and the differences between types, let's look at how it relates to actual transaction costs. Calculating the cost of the spread is straightforward. You need two key pieces of information: value per pip and the number of lots you're trading. For example, if you buy your USD at 1,356.40 and sell it at 1,356.26, the spread is 1.4 pips. To determine the total cost, multiply the pip cost by the number of lots you are trading. If you're trading mini lots, 10,000 units, the value per pip is $1. Thus, your transaction cost to open this trade would be $1.40. This cost is linear, meaning if you increase your position size, your transaction cost will rise accordingly. For instance, if the spread is 1.4 pips and you're trading 5 mini lots, your transaction cost would be $7.00. Understanding the spread in Forex trading is crucial for managing your trading costs and making informed decisions. Whether you choose fixed or variable spreads, knowing how they work will help you navigate the Forex market more effectively. For more insights and resources to enhance your trading journey, connect with us at K9 Investments Trading. Remember, knowledge is your best asset in trading.